When the markets shake, when interest rates rise, when portfolios crumble in panic, there are two types of investors: those who chase hype and those who get paid to wait. This is the story of the dividend fortress and the ETF that powers it. Horizon's Active Canadian Dividend ETF, ticker HAL. Imagine waking up every month and seeing your portfolio quietly, automatically pay you not some sketchy crypto yield, not a speculative flyer, but real income from Canada's most resilient companies: banks, telecoms, pipelines, companies that have paid dividends through recessions, pandemics, and everything in between. Let's face it, growth investing is sexy until it's not. When the markets dip, momentum dies. But dividend ETFs, they thrive in the quiet. And HAL, unlike most ETFs, doesn't follow the herd. It's actively managed. That means a professional team is behind the wheel, choosing stocks not just for yield, but for strength, sustainability, and timing. Inside HAL, you'll find the titans: TD Bank, Royal Bank, Enbridge, BCE, Manulife, Canadian Natural Resources. These companies have not only paid dividends, but grown them year after year, crisis after crisis. That's the kind of stability your money deserves. Here's the secret. HAL pays monthly. Yes, every 30 days. While other investments hope to grow, HAL gives you something today. Cash flow you can use to reinvest, to pay bills, or to build a cushion for the future. And over time, that income compounds quietly, relentlessly, like clockwork. Now you might be wondering, what about the others? VDY, great yield, mostly banks, passive. ZDV, smart rules-based approach. XEI, diversified, cost-efficient, solid pick. And HAL? It brings something they don't: flexibility, agility, and a manager that can pivot when things change. But here's the trade-off you need to know. That flexibility comes at a price. HAL's management expense ratio is higher than the others. While VDY and XEI cost about 0.22%, HAL charges around 0.66%. So you're paying more in exchange for active management and potential outperformance. It's not for everyone. If you're fee sensitive or prefer index simplicity, you might prefer a lower cost option. But if you want strategic positioning and adaptability, that premium might be worth it. How to build your own dividend fortress. Step 1. Open a TFSA or RRSP account. Use tax-sheltered accounts to shield your dividends. Canadian dividends inside a TFSA are tax-free. Step 2. Set up auto purchase of HAL monthly. Invest consistently, regardless of market conditions. Wealthsimple Trade or Questrade offer commission-free purchases. Step 3. Enroll in DRIP, Dividend Reinvestment Plan. Let dividends automatically buy more shares, compounding your income. Step 4. Pair HAL with other ETFs. Example: 70% HAL for income, 30% VQT for long-term growth. Balance income with appreciation. Step 5. Monitor, not micromanage. HAL is built for monthly income and professional oversight. Review once a quarter, not every day. You don't need to be rich to start. You just need to be consistent. And in a few years, your portfolio starts to feel different, stable, strong, predictable. You stop chasing. You start collecting. The dividend fortress isn't built overnight, but brick by brick, month by month, it becomes real. And it starts with one ETF, HAL, the ETF that pays you to wait. Like and subscribe for real-world wealth building ideas. Comment, are you Team HAL, VDY, or XEI?